Welcome to our Wednesday workshop. Got a great speaker or presenter, guest presenter with me today. We'll get to him in just a moment. But what I wanted to do is just thank everybody for joining us for another NuView Wednesday workshop. And we're just going to jump right into it. What I will tell people, if you have questions, go ahead and type those into the chat box if you are on Zoom. And if you have questions, if you're watching this on the live stream on Facebook, go ahead and comment in the comment section, and I'll have one of my IRA specialists reach out to you. So if it's any question regarding IRAs, self-directed IRAs, retirement accounts, and how those can be invested in things like real estate or other alternative assets, fire those our way. And then when we get to our speaker as well, and I introduce Matt Bowles, if you have any questions for him, go ahead and type those into the chat box as well. And he does also have his contact information if you have questions ongoing. So let's just jump right into it. And today's topic is we're going to talk about how to buy turnkey rental properties in out-of-state markets, and specifically, how do you buy those in a, quote, self-directed IRA? A lot of people don't realize you can buy real estate in an IRA. Every day we get calls nonstop of people that have heard for the first time in their life that they can buy real estate instead of stocks inside their retirement account, and they just never heard about it or didn't know a company that does it. So NuView Trust Company, we've been doing this since 2003. We're not a new kid on the block. NuView Trust Company is an IRA custodian, just like a Fidelity or a Charles Schwab is an IRA custodian, where we hold retirement accounts. The only difference between Charles Schwab, Fidelity, and NuView is that Charles Schwab and Fidelity are licensed securities brokers. They sell investments, which means they're only going to allow you to invest in the things that they sell, which is stocks, bonds, and mutual funds. And then you have these other companies like NuView Trust Company that doesn't sell investments. We say invest in anything you want in your IRA, provided the IRS allows you to do it, and we'll still act as your IRA custodian and manage those assets for you. So we've been doing this since 2003, and we have about 12,000 clients currently. And when I say investor clients meaning they are finding their own investments. Now that could be good or bad, depending on the type of investor you are. If you want to just sit back and just not do any work and hope that your stocks go well, that's fine. Invest that way. There's a lot of people that are confident in investing that way. But if you want to take more control of your retirement or invest in things that are outside of the traditional investment space and invest in things like real estate, well, then you have to be a little bit more active, but realize there's an IRA for you for those, I call them entrepreneurial type investors that would rather take their IRA money and invest into the things that they want to invest in versus just the things that they're sold. So we have about 12,000 clients that use their IRAs and other qualified retirement plans to buy alternative assets. And we'll talk about what those alternative assets are. And currently we have about 1.7 billion in alternative assets under management. So again, just showing you this to know that, we are not a new kid on the block. We've been doing this for a long time, and we have a lot of clients that do this, and they're the proof in the pudding, really, when it comes to self-directed IRA custodians. When I say self-directed IRA, though, if you're new, don't get confused with that term. When I say self-directed IRA, all I'm really talking about is that it's an IRA that you have to pick the investments. But it's not a type of IRA. It's not different. It doesn't follow different rules than just your IRA does. IRAs are all governed by the same set of rules. There's no difference between an IRA at Fidelity and an IRA at NuView. The only difference is what investments the custodian prefers to hold. So it doesn't have anything to do with the IRA. It has everything to do with the custodian you park your IRA at. So when we say self-directed, don't think it's some different IRA. It's just an IRA. And truthfully, most of our clients at NuView have IRAs at NuView, but they also have an IRA at Fidelity. They also have an IRA at Charles Schwab. And the reason they do that is because they like to move money back and forth depending on what type of investments they're looking at. So there's nothing stopping you from holding some of your retirement portfolio in stocks with a traditional custodian, and then having another IRA that holds some of your alternative assets that may be more tangible or more, in your investment wheelhouse, I would say, whatever you're knowledgeable about. What types of plans can you use to self-direct? Well, we have 7 types of plans here at NuView. So as you can see, the names are probably similar to what you already have now if you've got an IRA parked somewhere else. We have traditional IRAs, we have Roth IRAs, we have plans for employers. And that means if you're self-employed, which would be a SEP IRA, a simple IRA, or even your own solo 401k. We call it a solo QRP, which just stands for Qualified Retirement Plan. And we also have specialty plans that also can be self-directed. And that would be your health savings accounts and Coverdell education savings accounts. I'm not going to spend too much time on this because this is a different class, but if you want to learn more about these plans, we've got a ton of educational content on our YouTube channel and also our education resource page on our website. So I'll have more information on where to check that out. But when you look at these 7 plans here, what you want to think to yourself is, how can I use as many of these as possible? All of the plans that you see there are tax exempt, meaning when you buy and sell investments within them, your growth on the profit is either completely tax-free or in some case, at least tax deferred, which enables you to grow buckets of money faster than investing with your money as a tax-paying individual. So I always say set up as many of these accounts as you qualify for because you get the maximum tax benefits if you're using all of them wisely. But at a bare minimum, they also do allow you to diversify into the alternative asset space, which we're going to talk a lot about real estate here on this program. The tax savings, obviously, I kind of mentioned that. But with a self-directed IRA, the most powerful thing about them is you get to invest in what you know best. So if you understand real estate better than you understand the stock market, you're probably going to be better served investing in things like real estate in your retirement portfolio because you understand it better. If you understand note investing, if you understand mineral rights, cryptocurrency, the list goes on and on. Really, as an investor, what you should be thinking to yourself is, what am I comfortable with? What do I understand? And I want to invest my retirement in that. Doesn't make the investment risk-free, but it does alleviate the mistakes that will be made in the long term as you buy and sell investments. So we have all sorts of plans that can be self-directed here. Most of our clients have multiple plans. They don't just have one. What types of assets can be held in those plans? Now, this is what NuView specializes in, right? We specialize in administering assets that are alternative assets. Alternative assets most commonly are real estate, okay? And that could be fee simple real estate. It could be tangible real estate. And how they find that real estate, how our clients find that real estate, that's what maybe will help you on today's program and also last week's program. Because one of the things you have to keep in mind when you invest in it with a self-directed IRA is you have to find the investment. So do you have access to deals? Are you running proper due diligence on your investments? These are all things that you would have to do as the account owner. And that's not something NuView does for you. Okay. But if you understand how to find real estate and more importantly, do due diligence on real estate might be a phenomenal investment for you inside of a retirement account. But you can hold things other than real estate. I actually own notes secured by real estate. That's just what I prefer to do. Not because I don't understand real estate, but it just fits my lifestyle. I'd rather be a lender to other people who own real estate and I get interest payments on that. You could do both. We have a lot of clients that do notes and real estate, diversifying their assets. Or you can invest in entities that might end up holding real estate or doing something else. If you had to rank these in the order of the most investments we have here, private entities is probably the largest. Private entities and promissory notes are the largest, but I will say the private entities held here at NuView, most of them own real estate. So someone might have set up an LLC, they raise money to buy real estate, and the investment the IRA makes is to the entity, not directly to the real estate. Whatever you decide to do is completely up to you, but it always goes back to make sure you understand the investment, make sure you're doing due diligence, and make sure you can find the investments. And that's why I have my guest, Matt Bowles, on here today, is to talk a little bit about how you can find properties in out-of-state markets. With technology today, it's imperative that you find a way to find properties. A lot of people, obviously go, the old school route and they find properties within their own area, which there's a lot of advantages to that. But how do you find property if the market's not as good as maybe you'd like it to be. There's a lot of markets that are highly competitive. There's a lot of markets where people might think things are overpriced. So how do you expand and look into things out of state? I want to introduce Matt Bowles, and he's going to talk a little bit about his experience with Maverick Investor Group and talk about how they find properties, vet properties in out of state markets. Matt, are you with me?
Nate, I'm here. Thank you so much for having me.
Matt, thank you very much. I want to thank you again for having me on your webinar as well. I will tell people when we at NuView, we like to do presentations where other people are giving educational content as well, because that's really where the marriage happens there, because we can only talk about IRAs. Even though I understand real estate, I can't give somebody advice on investing in real estate. So I like to have people on that have experience. Matt has a tremendous amount of experience in real estate. He's been in real estate since 2004, but Maverick Investor Group has been in business since 2007. So that's 15 years just for Maverick Investor Group. And you've worked with investors all over the country to help them place their money or help them identify out of market deals that they might not have found otherwise. So I want to thank you. Matt Bowles is the co-founder of Maverick Investor Group, and we want to thank him for his time. And at this point, Matt, I'll let you take over and start sharing your presentation. And one quick reminder to the audience, again, if you guys have questions, type them into the chat box, whether it's for me or Matt, we'll get to them at the end here. So take it away, Matt.
All right. Thank you so much, Nate, for having me. Good afternoon, everybody. As Nate said, my name is Matt Bowles. I'm one of the co-founders of Maverick Investor Group. And you may have seen us featured in any number of the different real estate press or the mainstream media or the financial press over the years. We've been in business 15 years. We were named one of the top 50 real estate investment opinion makers and market leaders. And we've been doing one thing and one thing only, which is our niche specialty that we were founded to do every single day since 2007. And that is helping you, the individual real estate investor, buy turnkey rental properties in the most investor advantaged U.S. real estate markets, regardless of where you live. Okay. And we developed what we call the Maverick approach in terms of how we help our clients to use rental properties and build portfolios of cash flowing rental properties to hold over time to accelerate your wealth building velocity so that you can design your dream lifestyle and live on your terms. Okay. So the very foundational concept of Maverick Investor Group is that we want you to be able to do four primary things. Number one, we think you should be able to buy in the most investor advantaged US real estate markets, regardless of where you live. Okay. So live wherever you want or wherever you need to live, but don't let that limit or geographically restrict you from buying in the absolute best US real estate markets. The same way that if you're going to buy stock in a company, you don't care if the corporate headquarters are based in your hometown. You just want to own stock in the best company. We think you should be able to do the same when choosing where to buy your rental properties. Number two, we think you should be able to buy turnkey rental properties. So these are either brand new or fully renovated properties with tenants and local property management already in place when you close, so that you don't have to be the rehabber or the landlord, because your time is your most valuable asset. So you should be able to get all the benefits of owning the deeded real estate, owning the actual hard asset, without the headaches, the time-consuming headaches of being a rehabber or a landlord. Okay. Number three, we think you should be able to access off-market properties that are not available to the general public. Okay. So we have relationships in these investor advantaged markets with companies that source fully renovated, already tenanted, performing, cash flowing properties that are not something you can find on the MLS through a regular real estate agent. Okay. So we give you access to off-market private buying opportunity events. And number four, we think you should have the deals come to you so that you don't have to spend your time looking for them. Okay. So we, the Maverick team, we are out traveling around the country, looking at different markets, studying the different trends, looking at the unemployment rates and the economic indicators and the home prices and the price to rent ratios and all of those types of things. And then we're building these relationships with professional companies on the ground that are able to produce this stream of turnkey rental property inventory for you. And then we are just able to put it in front of you so that you can evaluate it. And then, of course, you'll do your due diligence on the deal. You'll send your home inspector in and do your appraisal and all that kind of stuff, which you can do from out of state. But if that property meets all your criteria and it passes your due diligence, you can just close from wherever you are. You don't need to go into the market to do that. And then you'll own a cash flowing rental property in an investor advantaged market with professional property management managing that property for you so that you don't have to be the landlord and deal with all of that. So those are the primary leverage points that we created, the value proposition that we have been bringing to our clients every single day since 2007. Okay, so for this presentation today, when Nate asked me to come and talk to you guys about this, the main things that I distilled this down to in terms of what I want to focus on today is look at number one, how do you identify an investor advantaged real estate market? Okay, what does that mean? How do you go about finding those, right? Number two, 4 reasons to buy your rental properties turnkey, okay? Number 3, how to conduct your out-of-state due diligence without flying into the market and walking through the properties. How would you go about doing that if you don't live near the property? Number 4, I want to share with you our number 1 most popular real estate market in 2021. Now, for context, we've helped people buy in well over a dozen different US states, okay, over the 15 years that we've been operating in. The reality is that the best real estate markets change over time, right? As property markets go through cycles and prices go up and down and rental markets change, and you know the economic indicators in the market change and things like that, right? So what is our number 1 most popular market in 2021? Where have our clients been buying more than any other market? I'm going to share that with you today. And then finally, what's the number 1 mistake that I see real estate investors making in 2021? It's interesting because people make different mistakes at different points in the property cycles over the years. So I'm also going to share with you the number 1 mistake I'm seeing people make in 2021. So this is what you are going to learn today on this webinar. We're going to rock through this less than 30 minutes, and happy to take any questions that you have at the end of this. So let's dive right into this. How do you identify an investor advantaged real estate market? What do we mean by that? Okay, first of all, let's talk about understanding demand drivers. Okay, so we look at things like job growth in a market, population influx, people moving into those markets to take those jobs, low unemployment, a diversified economy, okay, where there's a number of different job sectors, right, creating stability in case one of those job sectors has a problem, okay, increasing per capita personal income, right? People are making more money year over year. That's important as an investor because that means you can continue to raise your rents each year and people can afford to pay more for rent each year to you, the rental property owner, okay? Lower cost of living, revitalization projects going on in the city. All of these things are demand drivers. They attract people to a city, okay? And as the population moves into the city, as a low unemployment rate is maintained and people have steady jobs, these are all very good things for you as a rental property owner because it provides a strong tenant pool for you, a lot of people with very stable jobs that can afford to consistently pay you the rent that you need for your rental property, and people moving into the city, taking more jobs, creates upward pressure on those rents and continues to help to raise those rents year over year, which is good for you. Okay, now let's talk about price to rent ratios. All right. So there is a real estate metric called the gross rent multiplier. Very simple metric. You just take the purchase price divided by the annual gross scheduled rent that your tenant is supposed to pay you. Okay. So if you have a $500,000 property and rents are $2,500 a month, $500,000 divided by the annual rent, which would be 30 grand, you have a 16.6 gross rent multiplier. Some people also represent that as what they call a rent to value ratio, which in this case, is a monthly ratio, right? So $2,500 a month divided by 500,000 is 0.5% in terms of the RV ratio, right? Now, If you had a $100,000 property and the rent was $1,000 a month, all of a sudden now your gross rent multiplier drops to 8.3. The lower the GRM, the better, right? It's like a golf score. Okay. And your RV ratio, and this one, the higher the better, jumps up to 1%, right? So $1,000 monthly rent is 1% of $100,000 purchase price. So the second example, you can see how significant the price to rent ratio is there. Okay. Which is one of the reasons that when you start getting into markets that have very expensive properties, okay, oftentimes the rents are not going to be proportionally higher. Okay. So in that top example, a $500,000 property, it would be hard to find a $500,000 property that's a really nice property in a really nice area, in a market like San Francisco, right? They would be more expensive than that even, right? And they're not going to get proportionally the same rent. So these show you sort of the proportion of the price to rent ratios here. Now, the other thing though, that's very important is to look deeper than just the price to rent ratio. Okay. And to look at expenses. All right. So then we get into the capitalization rate. Okay. Capitalization rate is your net operating income divided by your purchase price. Okay. So you take your annual gross scheduled rent and you subtract all of your expenses, taxes, insurance, property management fees. If you have any homeowner association fees or owner paid utilities, sometimes 2 to 4 unit properties have some owner paid utilities for common area spaces, or landscaping, any of that kind of stuff, add it all on here. Okay. Operating expenses. Then be sure to always add an estimate for vacancy and an estimate for maintenance. Those are called non-fixed variable expenses. Okay. You know what your taxes are going to be every year, but you don't know what your vacancy and maintenance is going to be. So make an assumption for that and add it in. Okay. Cap rates need to include a vacancy and a maintenance assumption, right? And then you divide that by your purchase price to get your capitalization rate. Okay. Now, here's an important thing about this. All right. And this is why it's important to go deeper and to look at cap rates and not just look at those price to rent ratios. I hear a lot of new kind of novice investors talking about this concept of the 1% rule, which is that they want the rents to be 1% of the purchase price, which is that example, that second example I just showed you. If you have a $100,000 property, the rent should be $1,000. That's sort of a 1% rule, and people kind of go by that. But the problem is that if you don't look deeper than that into the expenses, into the cap rates, this rule can really lead you astray, right? So let's take property X here, $100,000. Monthly rent's $1,000. Property Y is $100,000 and a monthly rent's only $900. Which property is better? Well, the 1% rule would say you should take property X, take property X. That's definitely the one. I don't want property Y because it doesn't hit that 1% rule. And that's a rule that I learned about on some blog that I read, right? But wait a minute, when you go deeper, look at the difference in where these properties are located, okay? If one of them is in a market like Alabama and another one's in a market like New Jersey, the taxes can be totally different, okay? So this one that has $1,000 rent, that might be in a market like New Jersey where the annual property taxes are almost $2,500, right? So if everything else is the same, okay, you've got your same property management fee, 10% of the gross rent, your same insurance amount, the same maintenance and vacancy, or the same percentage of the gross monthly rent. Well, your cap rate on that one that hits the 1% rule is a 6.2%. But now if your other property is in a market like, let's say, Alabama, okay, you got a $100,000 property and the monthly rent is only $900, but the property taxes are only $410 as opposed to $2,400, right? So now you have the same numbers there, okay? Same amount of insurance, same percentage for property management rate, maintenance, vacancy, all that kind of stuff. And the cap rate is a 7.3. It's over a full point higher than property X, right? So this is why it's important to understand when you're looking at different real estate markets, okay? You're looking at out-of-state markets and you're looking at investor advantaged markets. It's fine to start off with the price to rent ratio just to get a general gauge of that, but always go deeper and say, okay, in this market, what are these property taxes like? What are the insurance rates like? What is, this other stuff, and get all of your expenses itemized and verified, and then look at the type of cap rate that you are going to be coming out of there with, okay? Now, the other thing to understand is property cycles. This is really important because all markets go through property cycles. Okay, so I can tell you that, for example, in 2011, our #1 most popular market that year was Phoenix, Arizona. In 2012, it was Atlanta, Georgia. In 2013, it was Houston, Texas. And I could keep going and I could take you out all the way and show you our most popular market in every year, but I'm just giving you an example here. Okay. Now, what's happened to a number of these markets that used to be our most popular markets is a process called yield compression. Okay. Where home prices go way up. So all of our clients that bought in these markets in these years, I mean, they crushed it on the appreciation side. I mean, they just got an incredible amount of home price appreciation. They did really well. They locked in their price to rent ratios at the time that they bought. So they're still cash flowing. They're doing great. Some people have sold, taken the equity, bought other stuff with it, done, all of that. But to buy there now, it's very, very different. And the reason is this process of yield compression, because home prices are rising faster than the rents. Okay. So if you were to buy there today, you'd be paying way, 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 way more for the house, but you wouldn't be getting the proportionally more for the rent. Okay. So there's a process of yield compression and the cap rates get squeezed, and they're much lower today than they were back in these markets. Okay, so these are the types of things that Maverick looks at when we help you to buy. When you come in and talk to us, have a video call with us and work with us on an individual basis and talk about your needs and your plan and help you to, when we help you to build your rental property portfolio, when you're willing to, when you're ready to buy, and as you're continuing to buy over time, we're going to continue to talk to you about what are the most advantageous to real estate markets to buy in at the time that you're ready to buy, right? So for example, take a look at some of these graphs. Look at the difference in this, right? This is the Phoenix, Arizona home price chart versus, say, the Indianapolis, Indiana home price chart. Okay, so you can see Phoenix crashed all the way down to the bottom. Great, it's cool to buy there at the very bottom, but now it's all the way back up at the top, right? Whereas Indianapolis kind of stayed really pretty steady, just kind of gradually rose, and then it was able to, the rents were able to kind of rise more with the rent. So it's been a much more stable market in terms of, the cap rates and where they are today versus where they are back then, versus Phoenix is just a dramatically different type of situation because it's more of that kind of roller coaster market, right? So you really got to time it properly. So these are examples of just market cycles and how different markets move differently. And you really need to understand where you are in the property cycle when you're ready to buy, okay? So let's talk about reasons to buy turnkey rental properties, okay? Let me make a real clear distinction up front, okay? Landlords deal with tenants, toilets, and trash, whereas real estate investors make decisions and cash checks, all right? Our clients want to be the latter. They want to be the real estate investor. Maverick Investor Group clients are not the people that want to go and, do the DIY home renovations and be in the house swinging hammers and doing the construction and, managing the tenants and taking calls at night and calling the maintenance people and dealing with all that kind of stuff. That's not our clients, okay? Our clients want all of the benefits of owning the hard rental property, but they don't want to be having the headaches of either the renovations or the landlording. Okay. So for some people that do, that's great. It's just not our client base. So every company has to have a niche specialty. This is our niche specialty. Okay. And so one of the reasons that our clients like to buy a turnkey performing rental property is that it gives you dramatic risk mitigation. Okay. In the entire process of renovating a house, okay, you have let somebody else absorb the risk of acquiring a distressed property. Somebody else priced out that rehab. If it went over what their estimate was, somebody else absorbed that, right? If it went longer than what they anticipated, somebody else absorbed those holding costs, right? If somebody else borrowed hard money to do the renovation and they had to pay more money to get it to a stabilized performing condition, somebody else already absorbed all of that. If it took longer to rent the property and get a tenant in their place and there was more vacancy up front, somebody else already absorbed that. When you buy turnkey, what we mean by turnkey, you're not absorbing those risks. They've already been taken by somebody else. You are coming in once the property is fully renovated, the tenant is in place, the property is already cash flowing. you're going to do your due diligence. You're going to verify, yes, the tenant signed the lease, and yes, they're paying this much money, and yes, they're qualified, and send your home inspector in, and yes, the property was renovated, and yes, it's in this condition, and everything else. And then when you close, you cash flow from day one. You evaluate the deal, you conduct your due diligence, and then you close on a performing property from day one. And our clients like that ability to leapfrog over all the upfront risk of getting a rental property to a stabilized condition, right? The other thing is you get to leverage economies of scale of professional turnkey companies, okay? So the companies that we're working with, they do these things all day, every day at scale, okay? So they're acquiring a large number of properties. They're buying their renovation materials in bulk. They're running all their own construction crews, okay? So they've created an economy of scale and they've professionalized this operation, and you get to benefit from that, okay? And then number 4, finally, you get to remove the geographic restrictions and buy in the best markets regardless of where you live, because it's turnkey, because you don't have to be the landlord, because you don't have to be the rehabber, because you don't have to be on site for any reason, because you have professional management company managing your property for you. You can buy the best markets and live wherever you want and not be restricted, okay? So those are the 4 main reasons why our clients love buying turnkey rental properties. And now let's talk about how to conduct your due diligence on out-of-state properties, okay? If you don't live near it, how do you conduct your due diligence on it, all right? Well, first of all, here are some steps that I would recommend, okay? And these are the ones you may want to write these down. First of all, verify all of your operating expenses. Okay, so you were going to be able to independently, publicly verify the property taxes. Okay, that's easy to do. You go to the website and you verify, yes, in fact, these are the property taxes, right? You're going to be able to verify your insurance, right? You get a quote from your own insurance company, like, yep, this is what my monthly payment is going to be, right? So you just go through and you verify every single expense that you're going to have, so you know your cash flow analysis is going to be accurate. Of course, maintenance and vacancy are estimates, but the other ones you can verify. All right. Property management company, you know exactly what they're going to charge. You're going to review their agreement. You're going to understand exactly what those fees are, and you're going to put that and make sure your cash flow analysis is accurate. Okay. Number 2, you're going to verify your rent. Okay. Verify that lease. Take a look at it. Is the tenant in place? Are they paying this much rent? Are they qualified, to pay that much rent? All this stuff, you can verify that before you close. Okay. Then what I recommend is also, in addition to verifying how much your tenant is paying, verify the market rent. Meaning, if your tenant were to leave that property, vacate, or maybe they leave at the end of the lease, right? Will you be able to replace that tenant in a timely manner for the same amount or more of rent that they were paying? Right? Are they paying the market rent? Okay. And one of the ways that you can do that is there are some services. One of the services is called rentrange.com. There's another service here, which ties into the next one, evaluating the risk of the micro market. There's a service called RentFax, RENTFAX, which pulls in the data from RentRange in terms of the market rents, but also gives you other data on, quality of the school district and, crime rates and like all that kind of stuff. And they pull all of that into a much more comprehensive report. Okay. And I actually put this website here because we have an affiliate a relationship with them, which means that if you go through this link, you can actually get your first RentFax report for free. Okay. Totally free if you use this affiliate link. And you can try it out. So either you want to try it on a house that you already maybe you own or you're familiar with. You want to see like, hey, what does RentFax say about this neighborhood, right? And the rents that I'm getting and that kind of stuff. Or you want to use that free report to look at a house that you're currently evaluating, right? So the first report, totally free. You can get it at this website if you want to check that out. But it's a great resource for doing out-of-state due diligence, okay? The other technique that I really highly recommend to people is interview multiple property management companies, okay? So when we present you a buying opportunity, right, we always want to say, oh, hey, there's a preferred property management company, which is the property management company that is getting the majority of the business from this particular provider. And they're therefore incentivized to manage your property pretty well because they want to keep getting all that business, right? And we want to be able to give you a preferred property management company. But you're always welcome to use any management company you want. And I always recommend that you interview multiple management companies to get totally independent opinions, right? Like you can just call up a random property management company that you find on Google in that market and just say, hey, I'm thinking about buying this property. This is the address, and this is the, square footage and bedrooms and, all that kind of stuff. It's in this neighborhood, it's in this place. What do you think about this property? If I was to give you the management for this property, what could you rent it for, and how long would it take you to get a renter in there for that amount, right? And let's say in a 30-day period, what could you lease this for, right? Things like that, right? And then going deeper with them and asking them questions about the neighborhood and what how desirable is this neighborhood for the types of tenant prospects that come into your company looking for rentals, right? Is this rental price point in kind of the high demand rental price point for this market, right? Things like that. And just kind of asking totally random third-party people that have no vested interest at all. They're just going to give you their opinion as local professionals that do property management work. So highly recommend that. And then of course, order a professional home inspection, right? Always, you're going to hire your own inspector. Doesn't work for Maverick, doesn't work for the seller, works for you. They're going to go and inspect that house. They're going to give you a report. They're going to say, hey, we recommend you get these things fixed before closing. You're going to give that to the seller, work out a punch list, and get those banged out before you close on your property. And then, of course, if you're using a mortgage to buy the property, they're going to require you to get an appraisal because they're not going to lend their money on a property that's priced over what it's worth. So the appraisal also will be, of course, totally independent. All right. So with all this in mind, what is our most popular market of 2021? I told you the most popular market per year tends to change and vary and shake up. And now that we're in the coming into towards the end, approaching the end of 2021, what has been our most popular market of this year? It has been St. Louis, Missouri this year. And I've been out there. If you haven't spent time in St. Louis, I was just out there a couple months ago, and this market is really, really hot. Just I'll give you a little bit of an overview in terms of why are our clients buying there in 2021. If you're not familiar with St. Louis, first of all, home to 8 Fortune 500 companies. The GDP in St. Louis increased 29% in the last decade. It's now over 170 billion. The St. Louis cost of living more than 12% below the national average, right? Things like that draw people to this market, right? It's ranked top 10 most competitive large MSAs to do business. It's ranked top 10 large American cities of the future. Unemployment well below the national average. This month, the Bureau of Labor Statistics says U.S. national average unemployment rate is 5.7%. St. Louis, 4.4%, okay? Qualified tenants with stable jobs, more so than the American average, right? Per capita personal income. Remember I mentioned this? Look at that chart in St. Louis. Goes up, up, up year over year. So you can continue to raise your rents as you renew your leases, and tenants can afford to pay higher rents year over year. As the home prices go up, people in the future can afford to pay more for that house after it's appreciated because their income continues to go up and up and up, right? Over the last year, okay, Federal Housing Finance Agency has their Q2 report just came out. Shows that the last year home prices in St. Louis appreciated 14.7%, okay? And bidding wars, all this kind of stuff, buying frenzy in St. Louis, pushing the home prices up, okay? Just Q2 alone, home price appreciation in St. Louis was 4.88% over just a period of 3 months, okay? This was Q2 of 2021. All right. So what does that mean exactly? Well, that means that for our clients that bought a property in St. Louis on April 1st, okay, on average, okay, let's say they paid $100,000 for a fully renovated single family home. Now, for anybody that's new to real estate and is watching this from a market like California or New York City or something, you're like, dude, did you leave a zero off that number? No. In a market like St. Louis, for $100,000, you can get a detached single-family home in a yard in a nice suburban area, fully renovated with the tenants in place, okay? So our clients, let's say they bought a house like that on April 1st of 2021 this year. Let's say they put 20% down plus their closing costs, so maybe they were out of pocket $27,000 for that house, okay? Well, by July 1st of 2021, at the end of Q2, those houses that appreciated the 4.88% were now worth $104,880, right? Well, that $4,880 in market appreciation that those clients got on a $100,000 house comes out to an 18% return on their $27,000 cash invested, okay? They put 27 grand out of pocket. They only put 20% down, but they get 100% of the appreciation. Okay, so that means that in just 3 months, they get an 18% return on their cash invested. And that's just from appreciation alone. Okay, that's not including the cash flow that they got from their, their net positive cash flow from the rents. It's not including the tax benefits that they got. It's not including the fact that the tenant also has been paying down their mortgage principal, right? Because the rent covers the mortgage and they're building equity that way. It's not including any of those things. This is just from the market appreciation last quarter. Okay, so I'm showing you why St. Louis has been so popular among our clients this year. Okay, and finally, the number one mistake that real estate investors are making in 2021, they're waiting to buy. And they're losing money by not buying in 2021. I can't tell you how many conversations that I've had, let's say, whether it was, in the end of 2020, beginning of 2021, people saying, oh, I don't know if I should buy now. Is the market is it going to do something? Is it going to correct? Is it going to do this? Maybe I should wait. And then they waited. And now look what's going on in St. Louis. Our clients have, there were people that were deciding whether to buy on April 1st. The people that bought got an 18% return on their cash invested, right? Already in 3 months. People that didn't buy are still waiting, right? So the bottom line is, when you're thinking about market cycles and you're thinking about, oh, well, maybe the real estate market will go down, or maybe it'll, this kind of stuff. Yeah, maybe it will. But if you buy correctly, you buy based on real estate fundamentals, and you buy to hold for the long term, that shouldn't really impact your buying decision very much at all, right? Because whatever the market does in terms of market appreciation, if it goes up, if it goes down, if it stays, the same, that doesn't really impact you as long as you bought a solid market, in a solid property in a high demand rental market, and you're collecting your cash flow every single month. You're taking your tax benefits every single month. Your tenant's paying down your mortgage every single month. So you're building equity that way, regardless of what the market does. Then market appreciation is really just a cherry on top. And if you hold this thing for 30 years, guess what? Whatever the market does in the short term, the long-term trends in real estate are quite clear, right? But let's say, even if, let's just say, it's never happened in the history of the real estate, but let's just say that 30 years from now, your house didn't go up a single dollar. It's worth exactly the same as what you bought it for 30 years later. It's never happened, but let's say it happens to you. Well, guess what? Your tenant would have paid down your entire mortgage by then. You would have built all of that equity, right? So if you put down 27 grand, now you have a house with $100,000 if it doesn't appreciate a single dime, right? So you already built that equity. Plus you collected cash flow every month. You got passive income every month. Plus you took the tax benefits, right? Plus you did all of these. So there's all of these profit centers in real estate. And if you buy right, you buy in the investor advantaged markets, okay? Then you're not at the, you're not at the mercy of market appreciation. You don't need the market to go up in order for you to make money, right? We want our clients to make money when they buy. You're going to buy a performing house, and they're going to start cash flowing the day that they close. Whatever the market does after that is not relevant to them on a day-to-day basis, right? They're going to look in 10 years from now and see what their house is worth, 20 years from now and see what their house is worth. In the meantime, they're going to be getting their mortgage paid down by their tenant, collecting their cash flow, and taking their tax benefits, right? So let me conclude this with a couple special offers for you. First of all, for everybody that's attending this live tonight, Wednesday, September 8th, we are actually doing a live private buying opportunity webinar event for off-market turnkey rental properties in St. Louis. And I want to invite you to attend for free. You can go to our website, maverickinvestorgroup.com. On the homepage, you're going to see a registration link to join us tonight. This is just a few hours from now. It's going to be at 9 p.m. Eastern time, 6 p.m. Pacific time. And you can register for free. Attending the event is totally for free. I'm actually going to be there with our property provider from St. Louis. You'll be able to meet that team. We're going to talk about the renovations. We're going to talk about the neighborhoods. We're going to talk about the property management solution. We're going to go much deeper into all of these things that I kind of gave you an overview here tonight. And there's going to be actual live available inventory for you to purchase in the St. Louis market. Okay, fully renovated, with tenants in place as condition of closing, right? That is the turnkey opportunity. And you can join us tonight to check that out. The other thing that I want to offer you is a free consultation, right? We do these usually now over Zoom with video, because we want to get to know you personally. We want to answer your questions. We want to understand your buying criteria, your real estate investing goals, and all of the clients that we work with. It's a long-term relationship-based thing, right? We are a licensed real estate brokerage, okay? But we are not transactional. We're not just trying to say, oh, buy a house and then we don't talk to you anymore like a regular like real estate agent, right? No, all of our clients, we're trying to help them meet investing goals, right? Passive income goals, wealth building goals for generational wealth development, right? So every client that comes in our door, our hope and our aspiration and our goal as a company is that we want to be working with you 20 years from now. We want to still be helping you to build your portfolio, diversify across markets, all of that kind of stuff. Okay. So we would love to get to know you personally and build that personal relationship with you and see how we can best help you. And so you can schedule with us a video consultation, totally free, maverickinvestorgroup.com/NuView. Okay. We're going to give a free video consultation to everybody who is attending this today, and would love to get to know you on a deeper level. Okay. Finally, I want to be super clear about how Maverick Investor Group makes our money. Okay. Because if you're going to be the client of a company, you should know exactly how they make their money. Okay. How and when do we get paid? How does this business model benefit our clients? Okay. Let's talk about this. We're a licensed real estate brokerage. All right. That means that we get paid a broker referral fee at each property closing. Okay. So that's how we make money. Now, the beautiful thing about this is that you don't have to pay that, okay? Because in the United States, 100% of real estate brokerage fees, right? Commissions, referral fees, all that, paid by the seller, okay? So this is one of the reasons I literally started this business model in the first place, okay? I was investing in real estate and I had friends come to me, and this is before we founded Maverick, right? I had friends coming to me and saying, hey, can you show me like what you're doing? Can you help me to like buy some properties too? I was like, sure, I'll show you what I'm doing. I'll help you buy properties. So I was helping them buy properties and all that. And, and then I noticed that the brokers that were helping us to buy these properties were getting paid, but that was cool because we weren't paying them. Right? They were adding value, but we weren't paying them. So that was cool. And then my friends started buying properties and all that. So when we started Maverick, I understood that this is an amazing business model because we can help all of our clients for free, right? Video consultations, helping you develop your real estate investing plans, helping you identify the best properties, supporting you, giving you resources, supporting you through your due diligence process, all that kind of stuff. You never pay for that. Okay. So we can help all of our clients do this and build their wealth without having to charge them any money. So it's like, this is the best business model ever. Okay. So we get paid. We just don't get paid by you.